Good afternoon, everybody. I am Mark Sebastian, the founder of OptionPit.com, and with me is quite possibly the best-looking lady in options, the queen, of the combo, the killer call spread trader, the sassy straddle buyer, Jill Malandrino, and Jill. Today we're going to have some fun things. Jill's going to do her market review. Then we're going to get a couple of directional plays from Jill, and then one from myself. Jill's going to talk about some hedges that she might do on some stocks. I'm going to talk about some basic approaches to using options in SPX and VIX, and then I'm going to talk about indicator hedging. So this will be a fun little webinar. We're going to be done with this by 4:45 Eastern, so that you have plenty of time to ask questions. All right, and with that, I will let Jill begin.
All right, so if we take a look at the 6-month chart in the S&P, it's essentially flat on the year. I think we're up as of the close today about 75 bips, but the tail of the tape is obviously much different below the surface. If you take a look at the beginning of the year where we are in terms of price, it doesn't look like there's been a lot of volatility, but there certainly has been plenty of volatility to trade around, particularly as we continue to break through new highs, but we also got as low as 2050 on the S&P and even a little bit lower. So there were a lot of volatility trading opportunities, but what's interesting is only 3 out of the 10 S&P industry groups are up year to date. All right, and that's technology, consumer discretionary, and healthcare. But in Q2, again, only 3 out of 10 were up. Technology moved out of that, financials moved in, which makes sense because of all the interest rate hike speculation. It's going to maybe happen sooner than later. But I think what's been really interesting with if you look at multiple asset classes is the macro impact that we've seen with commodities. We had such a significant sell-off in gold and, of course, crude oil from last year until now. And it seems ever since February, March, we've been stuck in a super, super tight range, particularly in energy. And it's really not a surprise here because supply and demand fundamentals are so severely stretched that many traders I speak with expect to see that really tight range in energy. We've really been between 56 and 62, and it just can't make a decision either way. We are in the key summer demand season right now, and we are just not seeing those drawdowns in the refined product, which is gasoline. So even though crude inventories are coming down, we're not getting it on the back end where the demand really lies. And the reason I think it's going to be in a range for the back half of the year is we're also coming into the shoulder season, which is the low demand season between October and December for crude. So barring any macro political events, or any changes in law regarding import-exports, I really think that's where we're going to be stuck. And we're actually going to look at a hedge on a long energy stock position so we can see how we can play around some of the dynamics working here. Gold, again, that's going to move on the U.S. dollar. It's all predicated with trading around the Greece headlines and, of course, interest rate hike speculation. Many traders that Mark and I speak with, they're exhausted with Greece. They're exhausted with interest rate hike speculation, and they just want to move on so we can kind of establish which direction the market's going to take longer term. So moving along, we're going to go through a couple of trades quickly. First one I'm going to look at is a directional, bullishly biased directional trade. Briefly, my fundamental thesis here is in Q1, the West Coast port shutdowns had a pretty significant impact on brand name retailers, so a Gap, an Abercrombie, because of how it's going to impact inventory. But for discounters like a TJ, like a Ross Stores, they could benefit because that extra inventory that these brand name retailers have on their shelves, it's going to flow down to the discounters. So I think it could be really good in terms of sales, and I think it could be really good in terms of margins because the prices could be a bit higher versus getting discounts passed down from the brand name retailers. So fundamentally, that's why I think TJ is pretty interesting at this point relative to looking at individual brand labels. If we take a look at the 3-month chart, getting pretty close to resistance there, and that's a trade that we're going to look at with a vertical call spread. You can see in our strike prices there. So what we're going to do is we're going to go out to August. We're going to look to buy the 65.72 half call spread for about 285. I actually put this part of the presentation together this morning, but because TJ had a $1.50 move today, it's going to be a little bit more expensive than what we have it on for, but the fundamental thesis remains the same. Chart actually looks a little bit better, so I'm going to stick with that one regardless of the price move that we saw today. Based on the numbers I had from this morning, again, it's 100% risk controlled. We know our max risk going in, and we know exactly what we can make, and you can see these numbers here. So based on the trade I selected this morning, we're going to profit if the stock closes above 67.85 by August 21st, which is the expiration date. We're risking 285 with a limited profit potential of 465. So I think this is one way that you can take advantage of a bullish fundamental thesis on a good-looking chart and have your risk limited. And I think it's really important to look at spreads, particularly as the market is seeing more volatility. And this is one way that I would look to trade it rather than going all in on just a stock position.
Oops. Sorry, folks. So now, one I was playing with is Fitbit. Fitbit is in the middle of what's called a short squeeze. What is a short squeeze? A short squeeze is when there's not enough stock to borrow for all the shorts that want to short the name. How do you spot a short squeeze? You have a stock that is spiking higher, and the implied volatility of the options is also increasing simultaneously. We are currently seeing that in Fitbit. So I think Fitbit is in the middle of a major short squeeze. It could go as high as 50 for all we know, maybe 55. Now, that being said, eventually every squeeze comes to an end. And when the squeeze comes to an end, the implied volatility comes in. So there is a level on this stock that I would want to own it. All right, it's not that Fitbit is all of that bad of a company. My brother's family all have Fitbits. So when I see people I'm related to using a product, it tells me that it's probably worth, really, there's some real value to it. And, they're light years ahead of the Apple Watch in terms of the health technology. And I think the Apple Watch is going to be a bit of a dud anyway. Please don't make insults about my mother for insulting Apple, but that's just the way I feel. So what I developed was what's called a 1x2 put spread. In this trade, I would buy one August 36 put, and I'd sell two of the August 32 puts, and I would take a credit of 10 cents. We will email out a copy of the slides with the
final registrants.
With the final registrants with the recording of the webinar. So Fitbit is one where I want to own it below 30, but I don't want any piece of it above really 32. So as you can see, the trade I've designed, as Fitbit drops and implied volatility comes in, I actually make money. You can see that really great area of profit for me. And below 28 at expiration, I take delivery on 100 shares of stock net. So it's an opportunity for me to buy the stock on a discount if it does want to drop below $28 a share. So that is my general trade I came up with in Fitbit. This is something that I might put in option profits tomorrow. So all those that are catching this are getting a sneak preview of my trade. All right, so now let's talk about a hedge and how you might hedge a stock that somebody might own.
So this is a hedge that we actually have on Action Alerts Plus, which is Jim Cramer's charitable trust portfolio. So in addition to managing options profits, I also contribute to another product called Action Alerts Options, which is the options overlay to Cramer's charitable trust. Mike Coe, who's from CNBC's Option Action, is the one that manages the portfolio. So we work on that together, and this is a position that we actually put on this Monday following the stock buy that the Action Alerts Plus team put on. So this is happening real time, and you can see how the thesis is actually playing out and how the hedge is protecting against some of the stock losses. So if we quickly review what the Action Alerts Plus team has to say about Marathon from a fundamental perspective, they like the stock because of the management team, even though it's in a really tough space. They're completely disciplined, they have their spending under control, they have successful cost controls in place, and capital allocation and divesting is really key when you're looking at energy assets because of what's happening in the underlying commodity markets, which is why I spent some time on what we're seeing happen in crude oil. They think in addition to what's happening in energy now, they're well positioned to grow production and accelerate it if market conditions allow. Their target is set for 32. If we take a look at this from a technical perspective, we can see that the chart is a bit weak. Technical score is only a 5, and it is pretty far off the mark in terms of meeting resistance levels. So the technical story tells a different tale than what they think fundamentally, but they think that this is going to be a stock that outperforms in a struggling space, and they're looking for that play to pay off. Now, one way that we look to participate in that with the Action Alerts Plus team was to put a hedge on, and there was quite a couple of reasons why. In addition to the chart being a bit weak and the energy space is just having a tough time because of what's happening with the underlying commodity, there is some significant exposure to the energy sector in the Action Alerts Plus portfolio, and we always want to be mindful of that. So while the position, if you isolate it from a directional perspective, it looks as if it's bearish because we're buying a put spread, but we're not rooting for MRO to go down, just like we're not rooting to get into a car accident. You're essentially buying insurance on your long stock position. This is what we put on Monday. The team got long at 27.14. We bought a put spread for 88 cents going out to August 7th. Okay, so this is a weekly contract. That's what the weekly W in parentheses represents. Company reports earnings on the morning of August 6th. So this gives us a little bit of a cushion to see how the stock will consolidate following the earnings print and another day after that. So we can either make our adjustments before, depending on what happens with the stock, and we also have a little bit of cushion looking a day further. Okay, again, a 100% risk-controlled strategy. It's going to serve as a hedge to long Marathon stock. So it's not bearish, even though directionally it looks that way, but we're buying some, well, actually the protection was much more cheap on Monday based on how the stock has reacted. We'll profit on the hedge if it's below 26.12 by August 7th. We're risking 88 with a limited potential reward of 162. So even if the stock remains under pressure, at least we're able to recoup some losses by using the options position.
All right, so now we're going to talk about some hedging techniques, and how we build a hedge, and because right now a lot of people are, Mark, how do I hedge this? Mark, how do I protect the portfolio? And in options profits, I've done some timely trading with VIX options, and I've done some and that have kind of worked out. But I want to talk about the different ways of building a hedge, and then the positives and negatives of all of the different hedge approaches. So SPX puts, all right, this is probably the most common form of hedging. The engaging in put buying in the SPX is what drives the VIX higher. All right, the VIX is a measure of how many traders are buying puts in SPX. Now, there are multiple steps to building this hedge. It involves figuring out things like portfolio beta, hedge ratio, downside tolerance. So let's walk through the steps of building a hedge. All right, so first you calculate your portfolio beta. So you take all the different stocks that you're trading and then figure out what is its hedge, what is its beta relative to the S&P 500. All right, based on that beta, you can then develop a delta to the portfolio. So the delta of the portfolio is as the S&P 500 rallies, how many points will how many theoretical points will this portfolio make? All right, so if the S&P is up 1 point, how many points will my portfolio rally? All right, so that's that portfolio delta. All right, then I calculate that maximum acceptable downside loss. So how much am I willing to lose on the downside? All right, then I pick a strike above that level as such that once the underlying is at that price, that option is somewhere north of an 80 delta. All right, and I generally do not include volatility assumptions when I'm building these things because you can never really rely on it, and it can kind of skew your hedge to be not strong enough. All right, so typically people that are buying puts are extremely risk averse, and so we are actually engaging in kind of figuring out that risk. So then we calculate that upside, then the final piece is we calculate upside capture ratio of a rehedge. So basically, as the underlying runs higher, how far is the put allowed to be out of the money before a new one is executed? So let's look at an example. I built a portfolio of Apple, Amgen, Johnson & Johnson, Google, Microsoft, General Electric, gold, TLT, and a few other large cap stocks. All right, so beta weighted to the S&P, I'm long 37 SPX deltas. So for every dollar the SPX rallies, I make $37. All right? Does everyone understand that? So for every dollar every dollar the S&P 500 rallies, my portfolio makes $37. So if I spend $1,200 on a 15 delta put, so that's a put that's nicely out of the money, I have a P&L chart that kind of looks like this, profit and loss chart. Kind of looks like this. All right, so you can see how the portfolio actually performs. All right, by buying that 15 delta put, you can see my absolute floor, all right, is around 1900, a little above 1900. All right. As the underlying rallies, I'm making money, and if the underlying tanks, I actually start to make money. All right, now what's the problem? You can see I am paying a decay on this. So if we sit here, I will lose some money. As we rally, I'm now picking up only $22 for every point the S&P rallies. And now the final piece is if I get to 2200, well, you know, that 1900 level basically accounts for about a 10% drop. At 2200, that 10% drop now puts me kind of into above 2000, which means I'm no longer hedged the way I want. So I have to adjust my hedge ratio. Now, the cleanest and easiest way to adjust your hedge ratio is with using options that are not long dated. So in this case, I've used August options. All right, so then August starts to get out of the money. I then sell them and roll to September, and so on and so on. This is how I build a hedge. Now, the positives, it sets a hard bottom. All right, there is a point at which I no longer can lose money. It's relatively easy to implement, and it allows for pretty nice upside capture. Now, here's the downside. It is expensive. It is really expensive to do a hedge. All right, so since 2009, if you did a monthly portfolio rolling of 30 delta puts, you would have experienced the same downside drag on a portfolio as how much money was lost in 2008. All right, so the other issue is you have this sticky strike concept. So even if you go longer dated, which can be cheaper, is cheaper, if in 2013, when the market rallied 30%, you had to roll your hedge a couple of times. You had to roll from 1600 to 1700 to 1800. So take a look at this chart of 30 delta SPX puts rolled monthly. Take a look at the P&L since September of 2007. You can see, you get look up here, you make a lot of money. And then check out how abysmal the performance is. I mean, May 2010 and August 2011 barely create a blip in your P&L. Isn't that fascinating?
Mm-hmm.
Right? I mean, it's incredible. Now, there are ways to implement this. I'm going to talk about that in a minute. I think there's smarter ways. So I don't want us to rule this out, but I think the one thing I personally have ruled out as a trade is monthly rolling of puts. Leaps maybe make more sense, but now you're dealing with all sorts of other issues. So now let's talk about a VIX hedge. All right, this has become a more common form of hedging because it hedges volatility instead of market exposure. Based on the futures, all right, which is the forward volatility swap, it is not a cash VIX product until the day of settlement. The day of settlement, there's a special opening rotation that does settle into VIX cash. Until then, it has a beta of VIX that at 30 days to expiration is about 0.5. And even the day before expiration is only about 0.9. So how do you build this? Very similar to an SPX hedge. You build a portfolio delta. You hedge a percentage of the delta using VIX options. All right, understanding that the beta of the VIX options is not the same and can move around. All right, typically it takes about 8 VIX call options to be one SPX put. It can outperform dramatically, especially early on in event trading. All right. So here's an example. All right, I built that same portfolio, and I buy some August calls. All right, and you can see the way Thinkorswim's beta is against SPX, it actually doesn't think it fully sets a bottom. It does. It does. Then you can see where the rally is. All right. The nice thing is that and I'm going to talk about this, with a big drop, a big VIX pop, take a look, you can move the whole curve. That's not something you can usually get out of SPX. So, and this is where VIX really shows its teeth. All right, the underlying's dropping, and you get this massive increase in volatility, similar to what we saw on Monday. And believe it or not, your VIX hedge absolutely crushes your S&P hedge. So now the positives. It allows for potentially, did I say downside? It's supposed to be upside. It allows for better upside capture. All right. If you hedge a portfolio with VIX options, generally speaking, it has better upside capture, especially in a bull market like 13 and 14, than using puts. It also solves the sticky strike issue. So think about where we are. Right now the VIX is at 16, excuse me. All right. 100 points ago, there was a point in time where the VIX was at 16. So the market can rally, and your hedge at a 16 strike or a 17 strike can still work really well. All right. Expensive. The negatives. It's expensive again. Correlation is tricky. It takes some work to use this hedge. All right. It's more of a convexity trade. See a lot of people do 1x2s on it, all sorts of things like that. It almost always outperforms early, then underperforms later as sell-offs continue. So if you look at 2008, do we remember when the peak of in VIX was in the 2008-2009 sell-off? Who remembers when that was? When was the peak of the VIX in 2008, over 2008-2009? Come on, people. Easy question. All right, well, the answer is the peak of the VIX in 2008-2009 was in November. It was actually November we saw the peak. All right, October was rough, but November was the peak. When was the bottom of the S&P 500? March 2009. So there's a disconnect between peaks in volatility and bottoms in the market. So you have to understand how to manage that position. 2011, we saw the same thing. The peak of the VIX was in August. The bottom of the market was in October of 2011. So in these big systemic sell-offs, VIX makes a ton of sense in the early portion of the hedge. It makes less sense after the absolute panic subsides. So now, any questions so far before I get into the better way? All right. I'm like a Pearl Jam song. All right. Up till now, you couldn't find a better man. But now I've got a better hedge. All right. So if you recall my little graph where I showed the cost of owning puts, it is not sustainable to hold a portfolio of puts. It simply isn't. So you can give up a 2008 type event hedging, all right? Or you can say, you know, there's some things I can't stop, all right? You can't stop a September 11th, you know, where the market drops. If a nuclear bomb goes off, you have better things to worry about. Those type of events, really out of the blue, the cost of hedging those is essentially astronomically high. So let's look at some major events. In 1987, if you look at the VXO, which is the VIX on the OEX, the original VIX, it had been up all week leading into the crash of 87. In 2008, the VIX rallied all the way through July and August, leading to that Lehman moment. In 2011, same thing. Vol was high, leading into the debt downgrade. The only real outlier that I can think of a crash that really came out of nowhere was the flash crash. But even that one, we had seen the market sell off a little bit ahead of time. Looking back to 1929, there weren't options or anything like that, but they look at how much the market was moving around prior to the crash of 29, and most people believe if there had been a VIX, it would have been rallying steadily into the crash of 29. So I'm going to tell you about the VIX VXV hedge. I would propose hedging or going to cash when VIX is higher than VXV as a simple indicator as to when to hedge. All right, while in the recent past, when VIX rallies above VXV, that has been an indicator that the market is oversold. If you go back to 2006, when SIBO first started listing VXV, that indicator gets you out of the way of a lot of trouble. And is almost always an indicator that there's serious problems. So the idea is when VIX gets above VXV, that's when you buy puts, or that's when you go to cash, or that's when you buy VIX call spreads. All right, it's a simple indicator. All right, so if the simple execution, if VIX is over VXV, go to cash or hedge. When VIX drops back below, re-enter the market. I ran a back test using this indicator. It substantially outperforms the S&P 500. Here's my back test. All right, and this was just a real quickie, simple one I did on a plane. All right, I personally have a much more complex one I use. If VIX is greater than VXV, I'm out of the market. All right, if the day before VIX was less than VXV, I experienced that day's loss to a degree. If VIX is less than VXV, but was greater than VXV the day before, all right, I only experienced 25% of the gains. So how does my portfolio perform? Well, take a look. With this approach, I avoid an amazing amount of the catastrophic losses from 2008 and 2011 and 2010. I should have dates in here. I don't. But we're talking 9 years of data, so not insubstantial. And using this, you experience almost all the upside and avoid a lot of the downside. This is just in the market or cash. Obviously, it's a very simple back test. Do your own research. Do what you're doing. All right. But this approach helps you avoid a lot of problems. So now, in summary, you can see that there are smart ways to hedge and that use of options can really do you a lot. My next webinar, I'm doing a webinar on Tuesday on calendar trading, calendar spreads. So if you want to learn how to trade calendar spreads, all right, it's July 7th, so next Tuesday at 8 p.m. Eastern Time. go to optionpit.com/calendar trading. All right. In addition, if you are not an OP member, all right, so if you're not a member of Options Profits and you would like a 2-week trial, I'll put this in there. 2-week Options Profits trial. All right, with some of my best ideas, email jill.malandrino@thestreet.com, and she will hook you up with a free trial. Any questions? Questions, comments, thoughts?
Oh, can you?
Oh, yeah.
Yeah, they switched that.
All right, data. I still think that's one that's going to turn around. Alibaba, I just posted, time to call, throw in the towel. That was one where when that vol really sank, I should have kind of looked at it and thought to myself, well, this vol's sinking and the stock stinks. So my own personal, biases got me in the way of how I would normally trade it, which would have been to buy puts. All right, and data, it will rally. I really believe that that's one that's going to rally here, just based on what it did the last time. It's one of those ones that's like to jerk you around and then as soon as you're out, rally.
Right.
So, and the calls are kind of worthless at this point, so I'd rather sit on them.
So usually when you do a directional trade like that, it follows the call. So why would the call move lower as it would be low? I mean, that's not common.
Yeah, that's typically. How do you go to the beta of the portfolio to the amount of VIX options? Well, like I said, it's not, you get the beta of the portfolio to the SPX. So the beta of the portfolio to the S&P 500, then you apply the VIX sizing to that SPX beta. And it's typically about 8 options for every, 8 options will equal the equivalent of 1 put option in SPX. All right, I just looked, and VXV is at 1679, right, and VIX is 1609. So VXV is above VIX. That is correct. In options profits, is it possible to get more premium collecting trades or more neutral positions? If you are an active trader, absolutely. I used to do a lot more of that, but I feel like our audience moved a little bit toward wanting kind of straight directional spreads. But, I'm happy to do kind of a premium collecting idea of the week.
Yeah.
So I'd be happy to put something on something like, do I have a rule of thumb for taking hedge profits? Yes. Every time my hedge doubles, I take half off. All right. Obviously, that'll change. Obviously, there's a little bit of nuance to that. If I feel like we're in the middle of a panic, I'll usually let it run. Could you repeat how you'd put the ideal VIX hedge on? So when VIX is above VXV, I would probably buy like an at-the-money call spread. So similarly, if you look at option profits, I put on a 1823 call spread for about 70 cents. And, when they're kind of flat. So that's one I really like. Do I have a rule of thumb? On the rule of thumb? Yeah, typically every time my hedge doubles, I take half off. But there's obviously some nuance to that. The indication of the hedge is when VIX is above VXV. Correct.
Is there?
Yeah, keep them coming, guys. All right, so make sure you register for my free webinar, optionpit.com/calendar trading, and email Jill for the free trial. On the directional trades that go against you, is it possible to get rolling trade ideas? I hate rolling trades. Paul Tudor Jones always said losers average down. I don't do that. I will add to a trade if I really strongly believe in it, but I'm less of a believer in rolling trades. I'd rather take it off and then go back in, if that makes sense. similar to rolling a trade, but when I take a trade off, I like to take a day or two to kind of sit on it and then enter. How about rolling the data out? I'm gonna let this is one I believe strong enough. I may just let it. I may really let take that one into next week, because I think if they get a Greek deal, because of the fundamentals and because of all the power behind that stock, it could get a lot of momentum. What about collars for existing individual stock positions? I think it's better to use. I mean, that's fine. I'm all for collaring. I think there's some smarter ways to set up a collar, and those when volatility gets really low can be some of the better times to collar. I'm more of a fan of portfolio hedging than collar hedging, individual trades.
Oh yeah.
All right. So Jill and I were just talking. I think we're going to start trying to do something together on a monthly or bi-monthly basis, even if it's in the middle of the day. The next time we get a real sell-off, I think we'll do something for option profit students only. Maybe option profits and option pit students only, something like that. Excellent idea. Well, thank you. Tell our boss the street that's an excellent idea. The way to get more stuff out of option profits is to tell people how much you like it. Besides, tell Jill's bosses how much you like it, and throw in suggestions. That's how you move things here. All right. The more email feedback they get from you guys on how great the product is, the more they'll get behind it.
Start slamming it on Twitter.
Yeah, and talk about how great it is on Twitter. They do pay attention. All right, guys. On that note, I will. I'm in New York, so I will probably email a copy of this out tomorrow night when I land back in Detroit. You're saying, what am I doing in Detroit? When I'm from Chicago, it's where my in-laws live, and they're watching my son. All right, guys. I appreciate your time and everything that you guys do. And so does Jill.
Thanks, guys.
Bye, guys.